Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is April 24th edition of Market Outlook. Don't forget to sign up for this by going to our website, www.marketgauge.com, and signing up, and you'll be getting this free video newsletter every week. So, first of all, let's take the top-down view of the market. As you can see, 1 week change, relatively meek response across the board, sort of an upward drift with the exception of NASDAQ, which was down 1.5% for the week. It got sort of clobbered with earnings from Google, Facebook, Amazon, all reporting poorly. So definitely these stocks hit, and NASDAQ down 1.5%, and also dragging on the year to date as well. Now, a couple things to note. We've been talking about NASDAQ being sort of a drag. You are in distribution mode, looking at accumulation versus distribution days. You've got 4 distribution days in NASDAQ. So that tells you that there is some distribution going on from institutional investors in the NASDAQ. On the other hand, relatively neutral across the board, with the exception that IWM, the Russell, which overall has really been the weakest, starting to gather some relative strength with 3 accumulation days and no distribution days. So IWM starting to pick up some relative strength, although on an annual basis, still quite a bit weaker, as you can see, down almost 10% relative to the other key indices. So making up for some lost ground. Okay, let's take a look at sectors. What's happening there? Well, first of all, we had been noting that utilities had been the strongest sector. It backed off this week as rates rose. Still outperforming in general most of the other sectors, but definitely has dropped off. So what you've got is some inflationary pressure, materials taking now second place in terms of 6-month returns. Still consumer staples, utilities, still picking up next next in line. So in essence, with those consumer staples and utilities still leading, market, even with it up all the way where it is, sort of in defensive mode. And so there you have it. Now, looking a little bit out in terms of market phase, clearly the short-term moving average, our 50-day is up above the 200, and you're trading well above it. So that, in terms of phases, is nicely in gear. And again, the number of sectors that are down on the year are very few. So that is a positive as well. Let's get into some of the market internals. First of all, we're going to take a look at the NASDAQ composite, or really the S&P 500, which is really the best gauge of the broadest and broadest market cap and biggest market cap stocks. So first of all, as you can see, nicely holding the 10-day moving average, and looks like the 50-day moving average really about to cross the 200 as well. That would put it into a full head-on bullish phase. Now, in terms of what the market internals are showing is, number one, up-down volume. Remember, we've been talking about the volume run-up here. The volume on the run-up has been relatively weak. We did get to a slightly overbought level and backed off. So volume still continues to be a concern. But we like to use this in conjunction with advanced declines over a couple different time periods. Those two have not kicked in to generate a sell signal. So in essence, McClellan oscillator which really looks out over the next 2 to 3 weeks, basically in positive mode above the flat line or the zero line, and that is a bit of a positive. Again, we got to oversold levels. It turned back above the zero line, and now we are just holding above it. So in essence, advanced declines looking not incredibly robust, but certainly positive. On a shorter term basis, however, looking at the S&P, you're really, really much better off here, and that's holding up nicely and confirming the upward move. So overall, looking at advanced declines, up-down volume, the only concern, of course, is that up-down volume ratio starting to trail off. But again, you need all three of these really to be in concert. And in essence, we have more net positives on the market internals for the S&P and New York Stock Exchange in general. Let's take a look at the composite, NASDAQ. Quite a bit of a different story here. Take a look. In terms of up-down volume, again, just being able to hold above the midline. Any further weakness, like we saw on Friday, is likely to trigger a sell signal, right? So we hit sort of overbought levels. After we hit overbought levels, we like to see it to penetrate that midpoint right here. At this point, we're trading above it. Once we get again below it, could resume the sell signal. In terms of looking out 2 to 3 weeks on the McClellan, that is a bit more positive as we got some more breathing room from the zero line. So that, again, a bit of a positive. In terms of advanced declines, you're actually moving up. And so net, advanced declines looking pretty good, even on that sell-off. So we're starting to hit, pretty rich levels. But as that momentum is going up, until we really hook down in a convincing way, it's a positive. So net, neutral to positive for the NASDAQ, although in general, because we're trading under the 10-day moving average, and you can see our 50 is quite a bit of a spread from the 200. NASDAQ is definitely the weak sister here and continuing to show weakness on a relative basis. But overall, the move above the 200-day still intact, although that gap down on Friday and the weak close under the 10-day, we really want to see it hold around 4,850 to 60. That's where that 200-day moving average comes in. That is your key level. And really, on a closing basis, under the recent low of 4,800 is going to be an important reference point to watch. Okay, let's keep on going here. Okay, so now we're looking at another good measure of internal health of the market, and that's the high-low rate, or the new highs versus new low ratio. So look what's going on here. As you corrected a little bit just for the last couple days, the new high, new low ratio improving in the spiders. So net, that is a good positive. Let's see what's happening with the NASDAQ 100 as well in this type of indicator, which is, again, new highs, new lows. Now, interesting, even as the market has sold off here on Friday, we continued to improve on new high, new low ratio. And now we're actually really approaching what I would consider a pretty bullish scenario. So pretty mixed with the message of the price action versus the market internals and the Qs. Looks like not the trend, not really severely threatened in terms of market internals. Let's take a look at some of the sentiment here. So we're looking at short-term volatility on the S&P. This is the VIX versus the S&P, and trying to get a sense of just how frothy the sentiment is. And as you can see, when you start hitting the bottom of the Bollinger Band, that indicates extreme bullishness. Right now, we're trading under the 50-day, under the 200-day moving average, but not really pushing extreme on the low end here in terms of the Bollinger Band. So overall sentiment, although is running a bit rich, it's not excessive. So I consider this still a positive. Okay, let's take a look at another sentiment indicator. This one is actually one of my favorite ones. This is looking at short-term volatility versus longer term. So that's 1 month versus 3 months. And as you can see, we're in a pretty rich zone. But what happened after the attempt at a sell-off in this area, we reversed, right? Right in this area, we reversed, turned up, closed above the 10-day, and our sentiment indicators moved with it. So right now, we're in a positive mode here until this really flips over, turns down, and turns down beneath the 1.2 level right over here. It's still in positive mode. So net, looking at all the sentiment, market internals, looking overall pretty strong, even though we did look a little bit weak on price action in NASDAQ. Other price action still positive. Okay, let's take a look at the TLTs. These are bonds. We mentioned, about how it's getting lots of national attention. When it makes the cover of Time magazine, sort of the arcane trading and use of interest rates and what the central banks have done, hits a mainstream paper or a mainstream magazine such as Time, it's time to sit up and take notice. So looking at the momentum of the long-term bonds, let's take a look. This chart on the bottom is a measure of momentum. So what I like to do is take a look on a longer-term basis, just how the momentum is acting relative to the price action. So look at this. Going back to 2009, financial panic, huge move up in momentum, and so fast forward a couple of years, 2012, again, new highs relative to the financial panic in TLTs, which equate to the lower interest rates, very, very low interest rates. And so what you see here is that the momentum versus the baseline, right, which is our 200-week moving average, has not reached the same extreme on the rallies. Now, recent highs back in beginning of 2015, look at this. So now you've got sort of 3 core new highs separated by multiple years, and the momentum is failing. Eventually, when that long-term momentum that's been so strong fails and breaks down, you're going to have a big move to the downside. But meanwhile, as you can see against the baseline, looking at the longer term trend, still intact. What we are concerned about, right, is those long-term effects and the fact that each time our momentum is waning. Now, what's important to know is key support against the 200-week moving average comes in at about -5%. So at this point here, what we're saying is basically somewhere around 114 to 115 level would break the long-term trend, and it could be a pretty dramatic move, right? Because you're breaking a very, very long-term trend, and the first indication, of course, would be the momentum failure. Now, let's take a look at the shorter term stuff. What I'm also a bit concerned about just looking at bonds on a 50-day moving average basis and that as your baseline. Take a look at this. You've already broke down underneath your 50-day moving average. But more importantly, if you look at the real strength of the trend and measured versus momentum, we've actually are close to penetrating something that goes back all the way to, in terms of its relative strength of the trend. If it gets much lower from here, you're going to be breaking down what the momentum was basically back here at a much higher level. So you're talking only another 2 or 3% from here move to the downside would basically trigger a really important support level relative when measured in momentum terms. So back down here, again, you're just talking about another couple percent to the downside. You did break down with a gap here. So we want to keep an eye on this. Obviously, interest rates really key to this whole picture. There's so much money pumped in, so much of asset appreciation is dependent upon what the Fed does and central bankers around the world. And you can see, that momentum certainly rolling over in the shorter term, and it could materialize if it continues into something really a lot more. So you got the key levels to watch here. So again, minus another 2 or 3% to the downside would definitely be taking out some critical levels. And that's going to be a lot higher. The momentum is going to be much worse, down about 2-3%. And so it's going to give you a lead and early indication warning about a much bigger potential fall in the bonds. All right, one last thing. Let's take a look at silver. Remember, we were mentioning just how strong silver is. I want to take a look at, again, the silver momentum. Take a look at this chart. Actually, you know what? I'm going to go to weekly momentum because that's going to give you a bigger and longer term perspective. So again, this bottom chart here is a measure of the momentum of price relative to about 1 year's worth of action. So if you're looking right here, you can see, looking back, we're basically trading at levels not seen since the latter part of 2011. So momentum really building, not quite as obvious on price. Did we get a nice breakout here? Absolutely. But the momentum is really building, right? You've got a sort of I guess a saucer here, or some sort of consolidation pattern that's lasted, well over a year to a year and a half. We are breaking out from it. Does that mean you can't get some sort of correction here? Again, support, absolutely, but that should really be a buy. So silver, definitely inflationary, looking really, really strong here. And I just want you to take notice, because this is sort of a unique way to look at price action. Just look at the pure momentum relative to a baseline, and you can see that we're really pulling out here. And Friday's action, even though we did sell off from the highs, put us in a situation where it's the highest close in multiple years on a momentum type basis. All right, that's it for now. Hope this helps. See you next week, and stay frosty, because the interest rates are definitely at a critical juncture.